morning and welcome to the Shenkman Private Client Group Accountant Attorney Spring Webinar Series. This program is entitled, Which Entity Structure is Right for Your Client's Business? For those who don't know me, my name is Jonathan Shenkman. I'm a financial advisor, portfolio manager, and an accredited investment fiduciary at Oppenheimer based in New York City. The goal of all my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 25 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, CNBC, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. After the program, I'll send out a link to all the publications where I publish my work. One quick note before I introduce our esteemed speaker, which is the handout to this program was sent out within the reminder email. It will also be sent out again in the follow-up email to this program tomorrow morning. Today, we're privileged to hear from Avi Sinensky, who serves as counsel at Uniondale, New York-based law firm Rivkin Radler. Avi has a broad-based transactional practice with extensive experience advising both buyers and sellers in the structuring and negotiation of complex private company mergers and acquisitions, investments, recapitalizations, divestitures, joint ventures, and other corporate transactions. He regularly advises companies from startup to maturity with respect to corporate governance, organization, and operations, and has substantial experience in negotiating shareholder and operating agreements, financing arrangements, private placements, service agreements, manufacturing distribution agreements, licensing agreements, and other commercial contracts. Avi also advises individuals and businesses in connection with business succession planning and the design of stock options and other equity compensation plans. Today, Avi will be speaking on which entity structure is right for your client's business. And with that introduction, I'll now turn the program over to Avi.
Thank you, Jonathan. Good morning, everyone. Really excited to be here. The discussion we're going to engage in today will hopefully be very useful for you the next time a client calls you, letting you know about some great idea they have for a new business and their whole plan for starting it up. And by understanding your client's long-term and short-term goals and the costs and benefits of the various entity options available to them, today's webinar will hopefully enable you to give them the proper advice that they'll need to get their business started on the right foot with all the proper entity choices. As Jonathan said, I am a corporate attorney and in the corporate department here at Rivkin Radler, where I advise both business owners and business investors on all of their transactional and day-to-day business needs throughout the business life cycle, everything from startup to exit and whatever comes in between. One of my favorite aspects truly of what I do is having the opportunity to work with entrepreneurs and other early stage businesses and really just helping them get off the ground and on the path to realizing their dreams, hopefully helping them to one day make a lot of money. And today I'm going to run through a version of the process that I typically engage in with my clients when it comes to choosing the right entity in which to house their business. Before we get started, I just want to kind of give a brief overview of the agenda for the next 30 minutes or so. Unfortunately, that won't leave any time for questions, but if at the end of the webinar you have any questions, anything you want to reach out about or follow up on, I'll share my contact at the end of the presentation, and you should feel free to reach out anytime. Feel free to use me as a resource, ask questions, anything of the sort. Our program today will be comprised of three main sections. First, we're going to talk about why a business even needs a corporate entity at all, and I will frame the main factors to consider when it comes to choosing one. Next, the bulk of the time will be focused on a deep dive of the various different types of entities and how they each score with respect to those different considerations that we're going to talk about. And finally, we're going to wrap up with a couple common pitfalls that businesses can experience once a decision of an entity choice is made, but before they get started with doing work. All right, let's jump into it. So the first question that I get a lot from clients is, I'm just starting a business by myself. Why do I even need an entity? Like, what am I even doing here? What's this whole thing? And the number one main reason why you absolutely must have one is for asset protection. A legal entity is a separate legal person from its owners, meaning that as a general rule, a creditor or a litigant won't be able to touch the personal assets of its owners. So for example, let's say we have John, he owns, let's say, a manufacturing business. He has a lease for the property, he has contracts with his customers, with his vendors, he has employees, he's got a lot of stuff going on. Now, let's say John's business, let's call it John's Manufacturing Inc. It hits tough times. Maybe there's supply chain issues going on in the world, inflation is rising, and all of a sudden he isn't able to fill those customer supply contracts in time. His customers get upset, they turn elsewhere, cash flow suffers, and he's not able to make his rent payments anymore. He's not able to make payroll. And frankly, a whole bunch of people are going to be pretty angry with John and be looking to be made whole. What the corporate form does ensure that the only target that those angry parties can go after is John's Manufacturing Inc. and its corporate assets, and very crucially, not John and his personal assets. John's house, his IRA account that Jonathan's helped him set up, his condo in Miami Beach, they will all exist beyond the reach of the company's creditors. I should note that there is a concept, it's very rare in corporate law, called piercing the corporate veil, in which a court would allow claims against the personal assets of the owners. But as I said, very rare. It typically would only happen in a case where there's fraud or where a court finds that the corporation was really a sham, that it was set up as a mere alter ego of its owners for the primary purpose of evading corporate liability. Therefore, it's of utmost importance at all times that any corporate entity have its own bank accounts, separate books and records, and take all steps to show that it is not just on paper, but actually in operation as a separate legal person from its owners. For that reason, it's very important that every business owner should engage competent professionals, whether it's an attorney or an accountant or a bookkeeper, to make sure that they are doing all of these corporate housekeeping items properly to make it clear that this is a separate thing. The second reason why it's helpful to have a corporate entity is that it can allow an owner greater access to outside capital. Banks that lend money typically are more comfortable lending to an entity with a corporate structure that they're familiar with. Similarly, outside investors are usually going to want to be issued some sort of equity instrument or debt instrument in exchange for their capital infusion, which requires some sort of corporate form. Likewise, a corporate entity allows for the existence of multiple owners in a business. Today, a business might be started by one person and have just a single owner, but hopefully over time it will grow and the owner is going to want to hire employees. They're going to want to bring in owners. They might want to bring on investors. And the use of the corporate form allows an owner to easily transfer a portion of her business to another person, whether that involves the issuance of actually shares of stock or the creation of a pool of stock options or a similar equity compensation vehicle that can be used to help attract and maintain good employees. A corporate form also allows a business owner to transfer shares to a trust or similar vehicle as part of their estate planning should they decide they want to start transferring all or a portion of their business to their future generations. As we move to our final two reasons, I'm reminded of the famous Benjamin Franklin quote that in this world, nothing can be said to be certain except death and taxes. Unfortunately, there's not much we can do to eliminate the existence of taxes, although we'll try our best to limit them. But the corporate form, surprisingly, actually can solve for death. One of the key benefits of the corporate form is that it has perpetual existence, meaning it outlasts the lives of its owners. The earliest form corporation still around today is the Hudson's Bay Company, incorporated in 1670, and still selling furs all over the world today. It's outlived its owners, I'd say, 10 times over at this point. Finally, we come to taxes, which in many instances is really going to be the determining factor in entity choice. And that's because it most drives at the actual economics. If done right, a corporate entity should hopefully be able to provide its owners the abilities to efficiently deduct their business expenses and offer flexibility in tax planning. So now that we know why a business owner should utilize a corporate entity, let's briefly touch on the main considerations that we're going to consider when choosing one. The first and usually most important, as I just said, is tax. That's the most, that's the one that ultimately drives dollars and cents the most. And what are we doing here? This is a business. We're trying to put the most possible money in our owners' pockets. As we'll see, we'll need to consider both the applicable tax treatment of the entity itself when relevant and of the owners when we think about this issue. Next, we have limited liability, which we talked about already. That's absolutely paramount. And we'll see that in virtually all of the entity types that we'll be considering today, limited liability exists. The next consideration is management flexibility, for which we'll see there is a wide range depending on entity choice, with some requiring a fairly rigid statutory structure on one extreme, while on the other extreme, we have entities where you can do pretty much whatever you want. And finally, we'll have to consider what, if any, compliance requirements a specific corporate form entails. In certain instances, that can make a specific entity choice more complicated or frankly unworkable altogether. Now that we know why we need an entity and we know what we need to think about, let's talk about what are our choices. We're going to talk about three main entity types today. We have the corporation, and a subset of that is the SCorporation and the CCorporation. We have limited liability companies, colloquially known as LLCs, And then we have partnerships, which are split into general partnerships and limited partnerships. So I did lie a little bit. I said there were three, but really there are five. But we'll see. There's three main categories that have subsets to them. Okay, so let's start with the corporation. The corporation is the most well-known type of corporate entity. Every business that is something that you've heard of, the Boeings, the Apples, the Walmarts of the world, they're all corporations. They're the earliest type of corporate form and the one that is historically been the most popular. And as I said earlier, there are two types. We have the S corporation, the C corporation. We're gonna come back to each of those individually in a moment, but first let's talk about corporations more generally. As I discussed originally, one of the main reasons you're doing this at all is to afford yourself the asset protection provided by limited liability. So let's just get a little bit more into that, just to the mechanics of how that works. The basic idea is that using a corporate structure means that the corporate loss to a specific owner can't exceed the amount that they have invested in the company. And this is really easy to think about in the context of investing in the stock market, which is something that most of us has probably done. So I think I looked last night, as of yesterday, Apple's stock price is trading at about $177 a share, which means if I buy one share of Apple stock and I pay $177 for that one share, the maximum I can lose is the $177 I initially invested. My upside, however, is unlimited. If Apple goes up to $1,000 a share by next week, I fully participate in that upside, even though my downside is limited to my initial investment. It's a pretty good deal. The same principle applies to owners of a private business. It's the same thing. Limited liability means that their maximum exposure is the amount of their investments. So whatever money you put in when the business starts, if you put in additional capital as the business grows, you could lose that, but regardless of how poorly the company performs, there's nothing else that they could come after. There are downsides to a corporation, however. It's not all rainbows and unicorns. First are the rarely rigid corporate formalities. Unlike some of the other entities that we'll get to in a little bit, which have greater flexibility, corporations are creatures of state statute, and almost every single state statute in the United States requires a whole bunch of documentation and housekeeping to occur, like adopting formal bylaws, holding regular meetings of shareholders and directors, keeping written minutes of those meetings, and having physical stock certificates. So from a purely logistical perspective, these might be the types of things that your client would rather they want to avoid having to deal with them, having to think about them. I know if I was a business owner, I wouldn't want to get bogged down with a bunch of paperwork all the time. Where the rigidity of corporate structures can play an even greater role is when it comes to the statutory management structure it imposes. Corporations are required to have a very specific management hierarchy, as I've showed you in my very fancy chart here. At the top, we have the shareholders that own the business. They elect directors who kind of oversee the long-term interests of the business. The board of directors in turn appoint officers, your CEO, your CFO, your president, and they manage the day-to-day operations of the business. This can sometimes create confusion, particularly in small, closely held companies where the same person will be a lot of these things. In a typical, one-person business, you're going to have a guy who owns the business. He's also the sole director. He's also the president, CEO. A larger business might have a little bit more people, but there'll still be a whole bunch of overlap. And it can just create confusion about who has the authority to do what sometimes, in what capacity is this person acting. And while there are ways to circumvent this structure, it is not as straightforward as in, say, an LLC or a partnership, as we'll get to it a little bit. As promised, we're going to now dig a little bit into the two different types of corporations, and we're going to start out with the S corporation, defined as a small business corporation which has made an election under Section 1362 of the Internal Revenue Code to be taxed as an S corporation. The S corporation has historically been used for many family-owned businesses or closely held companies, primarily because of the favorable tax treatment that it offers. However, in order to qualify for S corporation status, a corporation has to comply with a whole bunch of limitations on the number and types of shareholders that it's allowed to have. For example, an S corporation is capped at 100 shareholders, which might seem like an easy number to avoid today, but if this business is one that is going to consider raising capital from outside investors, it could very well end up with a cap table where that 100-person limit becomes an issue before you know it. And if this is a company that you expect to take public in the future, or at least in the foreseeable future, a 100-shareholder limit is a complete non-starter. You can't be on a public exchange and be limited to 100 owners. Further, an S corporation places restrictions on who is allowed to be a shareholder. The shareholders of an S corporation have to be domestic, they can't be foreigners, and they must be individuals, not corporate entities, although there are a few exceptions that are beyond the scope of today. So, for example, if one of your initial owners in your business is going to be your uncle who lives in Tel Aviv, an S corporation might not work. Similarly, if your major investor insists that he wants to own his interest in your company through an LLC and not in his personal name, the S corporation won't work at all. Another major restriction on S corporations is that they are not allowed to have more than one class of stock. So if your client is contemplating a very complicated waterfall for distribution of profits, where certain owners are going to get a preferred return, certain types of profits will be distributed in an uneven fashion for whatever reason, you can't use an S corporation at all. It just completely doesn't work. All owners in an S corporation have to be treated exactly the same economically. All distributions have to be made proportionally to one's ownership. So if I own 30% of the shares of an S corporation, I have to get 30% of the profits. I have to receive 30% of the distributions. There's no exceptions to that. The only exception to this general rule of one class of stock is that you can split the shares into voting and non-voting shares for purposes of management, but economically, all owners in an S corporation have to be treated pro rata. One other compliance matter relating to an S corporation is the requirement that its employee shareholders, so someone who's both an owner and also provides services, which is typically in a closely held corporation is going to be very common, must be paid reasonable compensation. Typically, the shareholders prefer to take their money out in the form of distributions because distributions are not subject to payroll tax and compensation payments are. However, the IRS thought of this problem, and in order to prevent S corporations from doing that, they now require that all shareholders who provide services to the company be paid reasonable compensation. Now, what does that mean? Like many IRS things, there's no strict definition of reasonable compensation. There's no bright line rules. The general rule of thumb is that a reasonable compensation is the amount that a similarly situated enterprise would pay you for the same or similar services. So this might require some market research, or it might require hiring an accountant or someone similar to give you some advice on the subject. So now that we've talked about all these different things that you need to comply with in order to have an S corporation, you're probably wondering, why are we jumping through all these hoops? What is it that makes the S corporation worthwhile and attractive? And of course, the answer, as we said at the top, it's because of the favorable tax advantages that it provides to its owners. Unlike a C corporation and an S corporation, taxes are not paid at all at the corporate level. They're only paid at the owner level. C corporations are subject to double taxation. They pay corporate tax at the corporate level and then again at the individual income tax level. So let's just run through an example. You think of a corporation that has 4 shareholders, equal shares, they each own 25%. And let's say the company earns $1 million in a year of profit. In the C corporation, the corporation itself would first have to pay corporate tax of 21%. So that's about $200,000 coming off the top. And then if the company subsequently distributes the remaining $800,000 to the four shareholders, each shareholder would get their $200,000, but they would have to pay tax again on that $200,000. As opposed to in the S corporation, the $1 million would be allocated $250,000 to each of the 4 shareholders, and then they would pay their personal income tax level on the $250,000. So in most instances, the shareholders will end up with more money in their pocket in the S corporation status. S corporations, the expression that's used is that the profits, losses, income deduction, everything passes through to the shareholders. The corporate entity is ignored for purposes of taxes. And it's one thing that is very important to note about this is that in the S corporation, the income gets allocated and the taxes become due and payable, regardless of whether distributions are actually made. There is a possibility of phantom income. If money has been allocated to you, you recognize that as income as an owner, even if you haven't received the money. So that's why many companies pay tax distributions at the very least, so that the owners are given money in order to pay their tax liability on a quarterly basis. This advantage of the S corporation taxation is actually not granted in all jurisdictions. There are a couple jurisdictions that don't recognize the S status. For example, New York City, the state of California, they do impose corporate income taxes on corporations, even if they have elected to be treated as S corporations. Finally, the S corporation also qualifies for a 20% qualified business income tax deduction, which can substantially lower the tax rate of its owners. So that's the S corporation and the basics. Now let's move on to the C corporation and discuss its own set of pros and cons. The main advantages is that the C corporation is not subject to any of those limitations on the shareholders that we just talked about for the S corp. The 100 shareholder limit doesn't apply. You can have as many as you want. The shareholders can be whoever you want. They can be foreigners, they can be entities, they can be trusts, they can be anything. The different classes of shares, if you want to do that with different economic rights, Series A, Series B, common, preferred, C corporation structure allows for any of that. And that ability is part of what makes C corporations so attractive to banks, VC firms, other investors. It's a structure that they're familiar with, and it gives them the flexibility they need to set up a corporation and with all the complications and complexities needed to allow for those types of investments. The shares of a C corporation can also be easily sold on a public stock exchange, and indeed, the majority of publicly traded companies, all the companies in the world that you've probably heard of, are C corporations. We previously talked about how the major disadvantage of the C corporation is the feature of double taxation, but it's important to actually think of it in a different way, because there are situations in which that double tax structure can be used as a benefit. Namely, if you think of the corporate tax as a mechanism to block the owners from any tax liability. Because remember, unlike an S corporation where you pay tax on whatever is distributed to you, regardless of whether it's distributed to you, in the C corporation, you only pay on distributions. So in a given year, your aggregate tax liability of 21% as compared to the 37% marginal tax rate if you're in the highest income bracket as an owner of a S corp could allow you to just basically keep all the profits in the business and without distributing, and year over year, you would be paying a lower effective tax rate until such time as profits are actually distributed. Okay, so next we're going to move to the LLC. Like C corporations, LLCs have all the benefits of limited liability without any of the shareholder limitations placed on S corporations. And like S corporations, they're also treated as pass-through entities. So some have argued that LLCs kind of present a best of both worlds that split the difference between C and S corporations. SCorporation has some nuances in terms of how it's treated differently with S corporations for tax purposes, like the reasonable salary requirement doesn't apply, and there might be a few other things. It's a type of thing you're going to want to discuss with an accountant, and he can run a side-by-side comparison for you. The major advantage of an LLC is that unlike corporations, which are governed by statute, at the heart of an LLC is a contract that as long as all of the owners agree and sign on a paper, they can pretty much do whatever they want in that contract. So all those corporate formalities that I talked about earlier, you can avoid all of them. You can enter into an operating agreement and really agree any deal you want. You want to provide that the 10% owner is going to get 50% of the profits, totally fine. You want to say that the 10% owner will get 100% of the profits until he gets back his $1 million investment, and then after that, it's a different arrangement, also completely fine. You can have the company managed by the members, by 2/3 vote, by majority vote, by unanimous vote. You could appoint managers. They could be members. They could be third parties. They could be me. The sky's the limit. Whatever you want to do is allowed. And it's really this contractual nature of the LLCs that makes them so attractive. It gives you the absolute maximum flexibility in terms of how business owners choose to operate their business, which frankly they should get to do because it's their business. So I'm a big fan of the LLC in almost all situations. Finally, we're going to move on to partnerships, which, like LLCs, are treated as pass-throughs. Really, it's more that LLCs are treated as partnerships because partnerships came first. But in today's discussion, LLCs came first. So we're gonna say it that way. And we have two types of partnerships, as we said before. We have the general partnership and the limited partnership. The general partnership, to be perfectly honest, is a relic of the past. It's rarely, if ever, a prudent choice for a business owner. I'm really only mentioning it so that if you're in a meeting where someone suggests maybe we should do a general partnership, you'll know why to tell them it's a bad idea. A general partnership must have at least two partners at all times. If there's two partners and one of them dies, the partnership automatically dissolves. The primary advantage and why some people still might use them is that they're extremely informal. It doesn't require filing anything with the state. All you kind of really need is an agreement between the partners. The major reason why you don't do it, and this is really what makes it a deal breaker, is that in a general partnership, all of the partners are responsible for the liabilities and obligations of the business, meaning that the limited liability that we've established as the linchpin of our discussion today does not exist in a general partnership. Whatever the general partnership is on the hook for, so are its owners. So that's really why it's off the table almost all the time. By contrast, a limited partnership still is very often used. It's starting to go a little bit by the wayside and being replaced by LLCs, but there are situations where it comes up, and it historically took the place of LLCs before LLCs came along. In a limited partnership, you have at least two partners, at least one of whom has to be a general partner and one of whom has to be a limited partner. The general partner, like in a general partnership, is liable for all liabilities and obligations of the partnership, whereas the limited partner is capped by his investments. So as a result, what you typically see is one general partner, which is usually going to be an LLC or other entity, so that no person has that unlimited liability, and then many limited partners. And the reason why that is done, it's used often in the context of investment funds, where you have the one managing general partner who makes all the decisions, and a large number of passive investors who understand that they have no management rights at all here. They're just putting in money and hoping to get a return. And the main area where I see this used is when money is being raised from foreign investors who frequently don't like to invest their money directly into the US and want to use an LP structure. And not every jurisdiction has LLCs yet. So, you'll often see LPs being set up in the Caymans or other foreign jurisdictions for these types of investment vehicles. Quick note, there are some additional entities that are sort of subsets of what we've already talked about. You may have come across. These are professional entities that can be used and in some states are required to be used for professional businesses like your medical and dental practices, your law firms, your accounting firms. And these entities are basically mirrors of their bigger picture entity. So, you have the PLLC, which is essentially an LLC. You have a PC, which is a professional corporation, which is essentially a corporation, almost always an S-corporation. And you have your limited liability partnership, which you'll typically see at the end of a name of a law firm, and it's essentially a limited partnership. And the only really key difference between these professional corporations and the typical corporations is when it comes to liability, where the practitioners in a professional entity can use the corporate form, but only to shield themselves from the liability of each other's actions, but not their own. So, a doctor who commits malpractice can't use the corporate entity to escape liability for her own malpractice, but when it comes to the malpractice of her partners in her business, there the corporate form would step in and protect her from being sued for her coworkers' actions. Okay, so now we've gotten to the end of the line there. We've gone over all the different types of entities. You probably by now in this process have figured out which one is the right one for your client in this situation. But there are two pitfalls that I often see, and the first one is not the biggest deal. The second one is a bigger deal. The first one is where to form, and to me, the most likely and straightforward answer, and usually the right answer, is to form the entity in the state where the business is going to be operating. You see a lot of businesses formed in Delaware, and when it comes to large corporate international companies, that makes a lot of sense. Delaware is very attractive. There's a reason why people go there. It's used because there's a very well-established body of business-friendly laws. We have a chancery court full of sophisticated judges there. But in my opinion, the advantages of Delaware are overstated for most startup and small businesses, especially if your primary place of business is a jurisdiction such as New York, for example, that also has business-friendly laws, also has a lot of smart judges. Further, in most cases, a business, if you're operating in New York and you register in Delaware, you're still going to have to go and register again in New York to qualify there and let them know that you're doing business there, which now means you're going to have to operate two different sets of registrations. An additional cost, additional maintenance, it lasts forever. And while there are definitely situations where Delaware makes sense, particularly in the context of real estate or where you're looking to raise capital from venture capital firms or other investors who are just really comfortable with Delaware, fine. There could be situations where it makes a lot of sense, but the home state is a perfectly acceptable, it's cleaner, it's easier in a lot of ways. Finally, there's been this recent trend of forming entities in jurisdictions like Nevada and Wyoming, and I would say there the principle applies more so. There could be a compelling specific reason why a specific business should be formed in Wyoming, a specific provision of Wyoming law, but I would say you should make sure your client has a really, really good reason why they're doing that and not just forming in their home state. Finally, I just wanted to say a quick word about the other major pitfall that I see, which is that many businesses think that they form, they can get started, but there really is one more corporate document that you need, known as a shareholders agreement in a corporation, an operating agreement in LLC, a partnership agreement in a partnership. They can be used interchangeably for our purposes. And I see this most when it comes to family businesses or businesses started among friends, where they think because we trust each other, we're early, we don't need something like this yet. And I can't stress enough what a mistake I think this is. I've seen so many situations where disputes break out among friendly owners who were once friendly, and then something happens. And the fact that there isn't a clear agreement that says here's what's supposed to happen when something like this happens, it just creates ambiguities, it creates arguing, and frankly, I've seen it ruin companies to not have something in place. What it basically does is it sets out the key provisions that as relating to economics, who's putting what into the business, what are they entitled to get, who makes decisions, do certain people have vetoes over certain things, is everyone's consent required for certain actions, and very importantly, are people allowed to transfer their interest? Are they allowed to A, transfer to a third party? Can I just go sell you my 10% shares of this private business? And what about involuntary transfers? If I die, if I get divorced, if I become subject to a bankruptcy and all of a sudden my interest in this business falls into a third party's hands, what can we do about that? Are there ways in which we can put in provisions that allows the corporation to repurchase those shares or keep them in-house? And while it's true that there is corporate statute, there are things that will often say what happens in a certain situation, you want to make these decisions by design, not by default. You don't want to leave it to the whim of what some legislator decided 40 years ago should happen. You want to sit down and to talk amongst yourselves and figure out if something happens to one of us, if one of us gets arrested, what happens to our shares? I like to think of this as the veil of ignorance. It's a term used in public policy making where you're supposed to, when you make a rule for how society is supposed to operate, you have to shed your personal situation. And if you wait till somebody gets indicted for tax fraud to say, oh, I wonder what should happen to someone in our business if they get indicted for tax fraud, you can be very sure everyone's going to be very biased in that discussion. Self-interest is going to take over. And this is just a very crucial document that just adds clarity. Everybody knows what's expected of them. Everyone knows their rights and responsibilities. And it also just provides a lot of stability to your business. So I can't stress enough that before you get off the ground, before don't wait until it's too late. Put something in place. It doesn't have to be complicated, but just something down on paper that everyone has agreed to. So that brings us to the end of our presentation. I hope that this was educational and helpful. As I said before, if you have any questions, don't hesitate to reach out. My contact information is on the screen. Just anything you want to run by me, pick my brain, use me as a resource. I'm happy to help out. This has been great. I hope you enjoyed. Have a great day, and let's kick it back to Jonathan.
Great. Thank you so much, Avi. If anyone has any specific questions, new business opportunities, or any other issues I'd like to discuss, please feel free to reach out to Avi or myself where appropriate. I'll be sure to include his contact information in the follow-up email to this program as well. As I mentioned at the onset, the goal of these programs is to stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. Two more quick items before I let you go. First, my next program will be on Thursday, April 7th on death, divorce, and assisted reproductive technology, estate planning, and family law considerations, featuring Alexis Sorrell, who's a partner at Warshaw Burstein LLP based in New York City. Second, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees. I thank you in advance. And with that, this concludes today's session. Please stay safe, healthy, and have a wonderful day, everybody.